Okay, I think we're on. If you want to comment, just do it in the comment section. And it's a little bit delayed. I don't know if I don't know how delayed it is. I thought I chose a setting that is not that delayed, but it might be. So to give it a shot, why don't you comment right now or just type something in the comment section so I can see what the kind of delay is. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. There we go. So it's about 10 seconds, I'd say. How you doing, guys? Gals? All? Glad you could join me. So what I wanted to do is talk about what the current situation is with the market, what we are doing, what our general strategy is, and what the trade was today. And I don't think there really is another trade to put on today. I've tried to conjure one up, but the market, for whatever reason, isn't cooperating with us. It's not giving us, something really of value. And let me also explain what happened yesterday. Unfortunately, had we stuck with this trade, now I didn't stick with it because, some people were freaking out about it, worried that the P&L was sagging, so to speak. However, I think what's going to end up is that the market's going to go down now, and had we stayed with the trade, we would have ended up with just a tiny, tiny little loss, which would have been whatever the debit was on the trade. For me, it was like $15. Instead, I took about a $350 loss to get out now. But let me just explain what's going on. So one of the complaints from one of the members was that they signed up for these tiny little risks and big gains, asymmetric. And the butterflies. Okay, so I introduced the butterfly because you could very easily put on an asymmetric trade with almost guaranteed, not fully guaranteed, but almost guaranteed small risk, and you could make the potential profit whatever you want. And they're a great trade. Sometimes they're just not there. Sometimes you have markets that are trending almost every day, like we've had. Of course, today wasn't a huge trending day. It was more of a distribution day. However, prior to us getting into today's market, it was a huge trend off of the bottom. And so it felt to me that we were going to continue that. Now, I guess an argument can be made that we did continue that, but we didn't really. Not the move that we've made today is about 1/3 the move that happened last night. So it really, and particularly with it being the open market, you would have thought it would have been bigger. And with the expected move being pretty high and volatility being above 34, every indication was that we were going to move very easily up into our T1 node. And so that was the trade. All right. Now, if that was the analysis for the trade, how do we put on an asymmetric trade that would take advantage of that? Also, keeping in mind that trade, we could have just as easily moved way up there and then move straight back down, or move straight through the T1 node. In that particular case, a butterfly would have been very difficult to try to extract the kind of profit that I thought was potential on a day like today, or in a market like what we have right now with the very high volatility. So we talked about this yesterday in the waning minutes of the market. online. Obviously it wasn't a trading day. It was an off day, but we talk on off days. And I said that, well, we had brought up the Batman trade as one possible solution. That with the
New visitor.
with the Batman trade, you put two very large butterflies, flank them on where price is right now, with the idea that price could move in either direction. Now, it's a great trade if you can get the P&Ls, and if you can get the kind of P&L that you want to get, and if price will cooperate and give you that type of trade. I couldn't really put on something like that. I mean, you could have, but and maybe some people did, but it wasn't going to yield the kind of return that you would hope for these huge moves that we've been getting. So last night, or yesterday afternoon before the market closed, in talking with a number of members about what trades to put on, I had suggested a back ratio trade, but we would do it in the same kind of vein as a Batman trade. So instead of two flanking butterflies, we would do two back ratios that have unlimited risk. That way, if we have a big move in either direction, it would work out. So I suggested that, and I put it on, and I'm sure that there are others that put it on as well. I know others put it on that were involved in the conversation. And we made a lot of money this morning because the market moved way up, and one side of that trade made spectacular money. For me, the trade cost 75 cents, and it wasn't an alerted trade because it wasn't a 0 DTE day. Really, it was Tuesday, and just putting ideas out there. That's all it was. So that worked out. So then the idea this morning was, since that worked out, it became clear that the market was on this new trend, and it looked like we were going to do a continuation because we were coming up into a pretty strong volume well with two inflection points. And if we had moved through those, by the way, we hit one of them. Those are the green lines, the inflection points of the low volume well. Hit one of them, hit the other one, but each time it hit, it kind of stalled. There was no continuation. It wasn't a, ugh. So where's the asymmetry? The asymmetry is in the overall cost of the trade. Now, putting on a back ratio, you can put it up so that if the trade goes totally against you, you can make the cost either no cost or even sometimes a slight little credit. In this case, it was virtually no cost. And I knew that this move would have to happen quick. It would have to happen in the first hours of the market. And if it didn't happen within those first hours, we would have to get out. As a matter of fact, I stated that in the comments. And let's see. Let me just look at something here. So I had said in the swag alerts, I said, this is a continuation off the bottom move trade. Super cheap. I'm expecting a sharp move up at the open, so quick profits, maybe within an hour or so. After which I think another trade will be placed if this one is successful. So it didn't really pan out. I gave it a little bit more time. I gave it about 2.5 hours instead of an hour. And it didn't pan out. It just, the market was like in mud. So we took the trade off. The trade cost me, because I put on two positions, it cost me $350. For other people, if they'd only put on one position, it would have been about half of that, say $175. Well in line with what the type of risk that we normally take. Now, the upside was huge. The upside potential, had it reached T1, would have meant that we would have made around $15 to $20, or with my two trades, that would have been $1,500 to $2,000 on virtually no risk that I had put on, right? Or no cost for the trade. So obviously that's an asymmetric trade, right? It's not the same as a butterfly. It's a different type of trade. It is designed specifically for this type of market where price is moving in huge swaths. If you watched yesterday's market and the market before, during the day it went up and down as much as 80 to 120 points in like 15 or 20-minute increments. It was unbelievable. There was no reason not to expect that to continue because nothing's really changed in the market or in the geopolitical spectrum. So, that's what was expected. What wasn't expected is a total halt and then just a sort of grinding sideways and then slightly grinding up. And now it looks like it's coming down. That wasn't expected. And but that's what happened. Right? So that's where we're at. That's what happened today. All right? So that is what happened today. Now, some people, I know from comments, committed way too much to this trade, and they're kind of mad at themselves for doing that. Other people were expecting another type of trade, so they're mad at that, right? It's not the the butterfly with the tiny little defined risk and the potential profit.
Returning visitor.
That trade simply wouldn't have worked today. I mean, if you tried putting on butterflies today, they were also just sort of flat until right at the very end. Then they're starting to grow very quickly. So they would have been disappointing. And had we had a big move, they could have moved right through the butterfly and been a non-trade also. So the butterfly just wasn't a great option today. Today was an option for unlimited risk. Unlimited profit, but I didn't want to take a lot of risk. So you started off with virtually no cost. That way, if it goes in the opposite direction, you don't get hurt at all. If it goes in your direction, potentially huge profits. The only caveat to this trade is if it doesn't go in your direction at the time that you want, right, there's going to be a problem because it will, the theta and the decay will start taking place, and it will be against you because this is really essentially a long call on steroids. And so it will start working against you. That's why I said that, we're looking for a quick win. If we don't, or even if it succeeds, we'll take the profit and then get out and then look for another trade later on. If it doesn't, then, I guess it was implied that if it wasn't quick, then it wasn't going to be a trade. But we got the opportunity to get out. Now, for me, that meant getting out at about, I think it was at about $2.50 or something, or $2 and I can't remember what it was. What did I get out at? Let me look at the fills. I put it in here. Oh, I got out at $2.85. All right, $2.85 was ultimately the cost of this trade. Now, how many other butterflies have we put on where $2.85 was a perfectly acceptable fixed risk? Most of them. Most of our trades are somewhere between $1.50 and $3.50. So we got out with what is our normal accepted risk. The difference with this trade was that the potential was actually higher than some of the butterfly trades that we put on, much higher. and a higher probability of actually achieving that, because we wouldn't have had to just pin the trade. We would have just had to go up, and anywhere up would have been great, and it would have been unlimited. So for instance, if we had a 100-point move, we'd all be laughing with $3,000 in gains after putting up a couple of bucks, right? So the big question is, how often should we do this? What if you lose, what if you're in this environment and you try this and you strike out 3 times in a row? Is that a losing proposition? Did we not take good trades with a good setup and a great potential and not really risk a lot of money? Now, if we're risking, thousands of dollars, I can understand, but we're risking tens or hundreds of dollars to make thousands of dollars. So because you don't win, does that mean they were bad trades? There's a question for you. All right. Let's see, a couple questions. Do you let us know when you are closing a trade? I let everybody know everything that I'm doing. Every single step that I make. My opening trade, I show the fills. My closing trade, I talk about the management of the trade in between. All of that from beginning to end. That was Brian. And Jim is asking, would we have been better off letting this expire worthless or proactivity close? It would have been, yes. But I don't know where it's going to go from here. That's a risk, Jim. There is a risk that we could move into the max loss zone, and that would be a catastrophic loss. So the strategy for this trade is either it works out or it doesn't. If it doesn't work out, then you get out. That's really, that's it. If it works out, fantastic. Now, putting this same trade on yesterday was even less of a risk because we weren't worried about expiration and the risky part, pulling the P&L down, where today we were. So yesterday we could stay in that trade for 20 hours and not really worry about it. Today, taking the same similar trade, we couldn't stay in for 20 hours. We couldn't even stay until the afternoon because we knew, or I knew, that the risk of the long strikes would pull us down and potentially give us a big loss. That's why I said in the beginning we're looking for a quick win. If we don't get a quick win, it's done. If we do get a quick win, we take the profits. Right? So that was the entire premise of today's trade. Let's see. I did close 2 for profit and let 2 run. Okay, I'm not sure exactly. Missing some context there. Do you often support this trade with a vertical spread to assist with theta problem as happened today? So this trade is essentially a long call or a long put, depending on which way you go, trade. But we put, it's a ratio trade where you use 2 long calls and 1 short. And what that does is that that removes a lot of the risk in the front end of the trade. So you can get into it cheaper, and so even if price goes against you, you're not hurt. So in other words, it's truly asymmetric. Virtually no risk if it goes against you, and only upside if it goes with you. But time is not your friend on this trade, right? You only have about half a day in order for it to make hay. And so that's why I said, hopefully within the first hour or so, we make hay. If we don't, then we get out. So hopefully everybody understands the nature of this trade. I hope I am describing it. Now, what I'm going to do is I'm going to draw it and illustrate it so that you can see exactly what I'm talking about. So what we'll do is we'll come over to the iPad. Let's move the iPad a little closer. Let's get up a little closer. And we'll create a new drawing. And so what I'm going to do is I'm going to create the risk the risk graph. And let's say that we are here, and this is at the money. So maybe this is the beginning of the day, and there's a lot of volatility. The VIX is at like 34. Our expected move is like 55 points, or more. It's actually been moving more than that over the past few days. On Monday, yesterday, it moved as much as 122 points in one leg. So that's our condition. Really high volatility. The butterfly is an option, but very possible that we could run right through it and then profit nothing. Plus, we're not really expecting that we're going to sit inside the butterfly or be able to get all its premium collection because of the volatility and the movement of price. It's just moving all over the place. So the answer to that is a back ratio spread. A back ratio spread is where you buy oh, that's awful. It's where you buy
Returning visitor.
2 longs and 1 short. And so it will create a trade that looks something like this. All right, and then the P&L line, when you get into it, will look something like this. And then, of course, this right here is your risk if the trade does not move beyond this point, which is your short strike. And these are your long strikes. That's your long, that's your short. So as long as we stay this way, this is our risk. If we go this way, then we are bound by the P&L line, which is this guy here. And we know that as time goes on, that P&L line is going to start moving into that shape, like that. And of course, this is what the problem was today, this area right here, where it moves below the risk to the left of the short. All right, JV, is there something in the course where you have a list of possible trade types and how to execute them? Yes. I talk mostly about the butterfly and the broken fly and the unbalanced fly. And I started something on the back ratio, although I haven't put a great deal into it yet, because it's relatively new to most people here. We've only done it a few times. Most of our trades are butterflies, so it's not fully vetted. I've done many back ratios in my day, and I understand it, and that's why I knew that we only had so much time before this P&L line started to move down, right? So if we're here and we want to go this way, our primary foe is time. So our primary foe is time. And again, that's why I said that, we're looking for that quick move. And, by all accounts, there probably should have been a quick move. It didn't make a whole lot of sense. Now, last night, we did something pretty cool. Let's go to the gallery and we'll create another trade. Last night, after a wild day in the market, we were at a low at the end of the market. It was just a horrendous day. Now, we had no idea which way the market was going to go, but we felt it could have gone way up or way down. So we were considering the Batman trade, and that looks like this. I'll show you. The Batman trade is why didn't that? I didn't want that color. I want that color. The Batman trade looks like this. Looks like that, where there are two butterflies, and price may be starting out, let's say, right here. That's at the money. So you put on these two trades, and they're measured moves. You're figuring, okay, I'm going to figure out how far away I want to create this, and then our the P&L line will look something like, I'll show you, like this when it starts out. Just flat. And then as it grows, it'll start growing like this. And then like that. So that's how it grows. So we're hoping that we get a strong move, and our move brings us somewhere in either this area or this area. The problem with this is that if you have a very strong market, then we really have no idea if price will go way out here or way out here. Which, of course, if it does a strong move and moves like that, it won't give the P&L line time to inflate, and we'll have a huge move and little or no profit. However, if we have an unexpected direction in the market and we don't have the kind of volatility that we have, let's say the volatility is down around 20 or something like that, then the Batman trade makes a good case for a market that is indecipherable. Are we going up or going down? Is the momentum? We don't know. Right? So that's the Batman trade. Now, this new variation that we put on last night takes takes care of the problem of huge volatility and huge moves that would go outside the Batman trade, and that's two opposing back spreads. So they would look like this. You'd have a bullish one. Oh, missed. There we go. You have a call one that looks like this. And then you might have a put one that looks like this. And then the P&L line, when you start off, will look like this. Now, if you do this far enough out, you don't really have to worry about this risk here, because it will never come into play, no matter what happens. That only comes into play when you get right down to the last waning hours of the trade. And then you'll start getting a curve that will start doing this. Right? But before that happens, if you're 1 day out, that situation never happens. You never get anything worse than, say, let me pick a color here. I'm going to pick orange. It never gets, say, worse than this. Right? So you never have a dip here. So a day out, if you're expecting huge volatility, this is a fantastic trade. And so that's what I had suggested last night. The market moved up, and I made about 13.25 points. So now, fast forward to this morning, it looked like the market still wanted to move up, and it was going to continue that move. So I decided to put on just the bullish side of this trade, this one, and see if we could capture the rest of the move. And we didn't have to move far, I was expecting, okay, if we can move out to, say, here or here in the first hour, we could capture a few $100s of profit minimum. And if we have a really strong move, who knows what you could capture? You could get, it could be as high as $1,000, $2,000 easy. It didn't have to go that far. But what did the market do? It did this and stopped right here, and then crawled like to here. And we're still right about here. After, well, it's 2 o'clock now, so it's been almost 5 hours, and the market has just dragged. So that's what happened. So the expectations were blown away. Now, again, the question comes, was this a bad trade? Right? That's what I want to know. Was this a bad trade? Did the premise make sense? Did the execution make sense? And the plan for execution make sense? Did we execute it correctly? So the answer to all of those questions is yes. It's a good trade. The plan was good. The execution was good. The exit was good. Just because you don't make a profit doesn't mean the exit wasn't good. Would you do this trade again? Again, the answer is yes. Given the same conditions, I would do this trade again. But what if you did this trade 3 times and you lost 3 times? Would you do it a 4th time? The answer is yes, because I know that those 3 times that I lost were probably anomalies. I believe that this is a very high probability trade. This trade will probably win 75% of the time. And the times that it doesn't win, let's say 20% of the time, you'll have the minimal loss. And 5% of the time, like today, you'll have a slightly larger than minimal loss, but still well within our asymmetric risk to reward. Okay? So hopefully people understand that. Now, just because you don't win trades doesn't mean that the trade wasn't good. This trade was fantastic. The trade we put on yesterday was, great. I guess it wouldn't have mattered if I had put the trade on. Most people would not have seen it. Only the people that were like hanging out at that time would have seen it. So it really wouldn't have mattered. So that's why I didn't put it. It wasn't a 0 DTE day. So there it is. There it is, all laid out. Why this trade was taken. It was an asymmetric trade, like everything that I profess. It is different than the butterflies for sure. There's only a few ways that you can fail on this trade. And of course, the one way that you can fail on any trade is if you overcommit your account, if you just trade way too much and you get into trouble. And so, for instance, when you should only be taking 1 or 2 positions, you take on 10 or 20 positions. That would be one way. The other way is just not paying attention and just hanging into the trade too long as it turns into a loser and falls into, say, one of these pits. And you're hoping that you'll get a strong move one way or another, but it never comes. Like today would have been one of those days that could have possibly happened. Now, it just so happens it hasn't gotten into the pit. It's stopped short of the pit. It stopped here. That's where it is right now. However, it's still experiencing this sort of sag, but by the time expiration comes around, that sag will be gone and then the risk will be minimized. So that's the other way that you can, in poor execution. So they're really both 2 poor execution ways that you can fail at this trade. You can overcommit, or you can hang on too long with hope, and that's basically not following the plan. All right. Any questions on how I've explained this and what this trade is about? So let me say this again. This is, not only is this an asymmetric trade, but this is like the ultimate asymmetric trade. This is way better than the butterfly under the conditions that we have right now. It is way far more effective. Taking this kind of chance right now. Let me get back to the big head here. So taking this kind of chance in this kind of market makes way more sense, because we could have potentially made a crap load of money with very little risk. And as it stands, even though the risk may hurt or the loss may hurt, it's still very, very small compared to the potential. And it was in line with the kind of risk that we take even with the butterflies. Okay? But that's about all I have to say. And hopefully this will make sense to all of you and the people that watch this later. Are there any questions? So we have to give it 10 seconds. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So if there were questions, they would be popping up like right about now. But since they are not, then I assume everybody is good with this. If you are, say yes. If you're not, say no. Are you good with this trade? Is it the type of trade that you think we should be putting on if you follow that plan? Minimal risk, maximum potential profit. Excellent. And because it didn't work, again, does not mean it was a good trade. It was a damn good trade. It worked for us last night. It just didn't continue today. So one thing that I think that I will do, though, is if we get another situation like last night, I will post it and alert that trade now that you're aware of this trade. And I'll make sure that everybody knows. I'll even put out an email alert besides just putting it on the Discord. Because these are things that, why give up this type of opportunity when it's there? Okay. That's all I've got to say. I hope everybody has a great rest of the afternoon. Hopefully you learned something from this, and this is another trade that is definitely going into our arsenal. It's a fantastic asymmetric risk to reward trade, putting up very little capital for the potential of making huge returns. And we will also expand it to 1 DTE trades so that they will go into the 0 DTE day but be executed the day before, thereby not experiencing the well risk that you have, or the dip in the P&L. All right. Thank you very much, and we'll see you next time. Maybe we'll get one of these showing up tomorrow for Friday. That'd be cool. See ya. Peace.